Good morning, everyone, and thank you so much for joining us this morning for our retirement webinar series. This is Deanna Bamford from Pensionmark Retirement Group, and this morning in the next hour, I hope to enlighten you a bit about the basics of retirement plan investments. First, let me start with a couple housekeeping items. I have muted your lines so that everybody can hopefully hear clearly. I would appreciate if you could mute your phones as well, as this is my first webinar, believe it or not, with my 18 years with Pensionmark, so please forgive me for any technical mishaps. Hopefully everything will go smoothly. I will be taking questions at the end of the presentation. You can type in your questions in the chat box at any time, and I will refer to those at the end. So thank you. I appreciate your participation. With that, let's go ahead and get started. And I did want to mention that this is the first of a series of 2 webinars. Next month, I'll be doing a bit of a sequel to this presentation on June 21st, and I will cover in the second meeting a little bit more in-depth review of asset allocation and diversification. But today, what I'm hoping that you'll come away with from this meeting is a better understanding of what your actual investments are made up of. Our goals today are to identify the 3 major asset classes, talk about the risk associated with each, here we go. I believe you are now seeing a screen that you shouldn't be. Please bear with me for just a moment here. Here we go. We should be back on track. I apologize for that. Again, as I had mentioned, first time, I will get this right. Okay, so in addition to covering the 3 major asset classes, communicating the risk associated with each, then we'll actually bring it into how it's affiliated with the investment options offered in your retirement plan. Again, the goal is for you to better understand where your money is being invested. Let's now look at a comparison of the 3 asset classes. The 3 main asset classes are stocks, bonds, and cash. Each asset class has different return and risk characteristics. There is great potential with the stocks, which you see there on the blue arrow, are at the higher end of the risk scale, but also with that comes higher potential returns. And then you have your bonds next down, and then you have your cash. And we're going to go into each one of these in quite a bit of detail. First, let's start with your cash, or short-term investments. Now, these investments are designed to give you a certain amount of interest and protect your principal. They're relatively stable, meaning there's very little volatility. There is potential to earn some interest, but there's also potential to not earn enough interest to keep up with inflation, and we're going to talk about that more as we go on. Now, there are several different categories of short-term investments. There's different ways to categorize them, so we can talk about what the fund invests in, ways to invest, and also the issuer, whether it's a bank, the government, or another financial institution. Now, unlike most bank products such as CDs, money market mutual funds or these cash type investments are not insured. So they're not guaranteed in any way. But again, this is the most secure short-term type investments of the 3 main asset classes. Now let's learn a little bit about the bonds. Basically, a bond, although you say you're buying a bond, you're really not buying anything. We refer to bonds as IOUs or loans. That's why they're often referred to as debt securities. So when you actually purchase a bond, you're basically lending your money, and you're hoping that you're going to earn interest on it. Well, not hoping, you are actually guaranteed a certain interest rate by the seller of the bond. Okay, so on the scale of risk, bonds are going to fall in the middle on the three main asset classes. You've got cash, lowest risk, then you've got your bonds, moderate risk, which in return equates to a potential moderate rate of return. Now let's look at the different types of bonds. There are a couple of different ways to categorize bonds. One way is to look at the credit quality of the bond. Bonds can be classified as either investment grade or high yield. You may have heard these terms before. Investment grade bonds generally offer a lower level of risk, but also have potentially lower returns. High yield bonds, on the other hand, typically are issued by smaller, less mature companies, less likelihood that, or actually higher likelihood that these companies could default and not be around to make good on your interest payments. Sometimes these high yield type bonds are referred to as junk bonds. That might be a familiar term to you. So these are looking at the different types, issuers of bond, and then you can also evaluate a bond by its maturity date. The longer the length of the bond term, the higher the risk potential. Because during that length of that bond, there is a greater chance for interest rates to fluctuate. Okay, so the longer bonds tend to be more volatile. Now let's look at this, how that really affects these different bonds. You might have seen this 9-box matrix before. We use it often, and we will in this presentation, to look at stocks. We also can use it to look at different types of bonds. And it helps us examine to look at both the maturity rate of the bond and the issuer of the bond. So across the top there, you've got the maturity, whether it's a short-term, intermediate, or long. And vertically there, you've got the quality of the bond, high quality, moderate, or low. And again, that depends on the issuer. So your government-type bonds are going to fall in the higher quality, better chance of getting your money back. And then moderate and low are going to be more corporate bonds or municipalities with a higher chance of default. So now let's take a look at stocks, the third and last asset class we'll be talking about. What is a stock? Unlike a bond, we are now actually talking about owning something. Okay, so the bond we like to refer to as loanership. With a stock, we're talking about ownership. So when you purchase a stock, you actually are purchasing a share of a company. So that's why we refer to bonds often as equity ownership. So you'll see that term equity used in lieu of stocks often. Now, of course, with a stock, you are a bit of an owner in the company, so you get to partake in the good times and, unfortunately, on any of bad times. And the economy, as we know, can influence the price of these or the value of these stocks as well. So with a stock comes higher risk, yes, but in turn, higher potential for return. And historically, we'll look at some charts in a minute here that actually show better returns historically. Now let's discuss asset subclasses. So as we broke down the bonds, let's now break down stocks. One way to break down a stock is by market capitalization. And perhaps you've heard the term market cap. We throw these terms around quite a bit, and sometimes we forget to really explain what does that mean when we talk about large cap, mid cap, and small cap. Bottom line, the way that we determine the market capitalization of a stock is by multiplying the number of outstanding shares times the share price. And then, depending on what that is, if it's over $10 billion of market share, then we're referring to large cap stocks. $2 to $10 billion, we're looking at a mid cap, and less than $2 billion, we would normally label small cap. And again, I know you've heard these terms, but it's important to understand the difference. Now, there's one other way to look at stocks, and that is by style. So this is market capitalization. Next, let's take a look at style. And we're looking at value versus growth. And again, you may have heard these terms. Two different philosophies for investing. With value, a value-oriented manager or stock is looking for solid companies that are undervalued by the markets or perhaps temporarily out of favor. So they're kind of looking for a bargain, something on sale with a good possible turnaround story. On the other hand, a growth-oriented investment manager or a growth-oriented stock would be looking for companies whose earnings and profits are growing faster than the industry or overall market. So this potentially, you're willing to pay a higher share price up front because you believe something in this company is going to grow better than the others in the same market. So you're willing to pay a premium for the potential earnings long term. So two different philosophies, and sometimes you might think, well, why don't we just go for the growth? That sounds, like the way to go. But traditionally, these two styles have gone in and out of favor at different times, and it's pretty unpredictable. So it's important to realize that there are two different styles and that both are probably necessary for a well-balanced portfolio. Now here is that same little matrix, the 9 style box grid that we looked at for bonds, but now we're going to look at it for stocks. Here we have the two different investment styles across the top, horizontal. We've got value on the left and growth on the right. When you see blend in the middle, all that means it is the fund manager or the stock is combining both value and growth in the same fund. And then when you look down vertically, you've got the market capitalization. You've got the large cap, if you would call $10 billion or more, the mid cap, $2 to $10 billion, and then the small cap, below $2 billion, traditionally in market capitalization. So these are important and interesting. Most of the funds in your plan, if you look up a fund fact sheet, you'll see one of these kinds of matrix. I'm sure you've seen them. We have them on our newsletters and such. So hopefully you'll have a better understanding when you see a check mark there. If it were a mid-cap blend fund, then you would know that the fund that you were in invested in medium-sized stocks, $2 to $10 billion, that invested in both value and growth type companies. Stocks, now to take it one step further with stocks, they can also be divided based on their geographic emphasis, where in the world they invest. So one more sub-asset class of stocks is where they invest. So when you're talking about international stocks, which has had a lot of publicity, and we still believe is a very important part of your total portfolio, we can look at whether they are investing including the U.S. or not, by where they invest, if it's a specific region, and also what segment of the market, like the stocks and bonds we just considered. International investing could also include bonds, and in the stock portion could include small cap, mid cap, large cap, growth, value. So again, just can be further broken down. And again, I think the international investing just opens up a whole new potential for growth. Again, with that always comes a little bit of risk potential, and with international investing, can be even a little greater because now you're talking about politics and currency and other factors that could affect your overall performance. But there is, again, so much potential and so much that's being produced outside of the U.S. these days. It's an excellent way to further diversify and increase your overall return. So finally, a little bit more on the international investing. A couple different ways to invest, and potentially your particular plan may offer more than one international fund. If you have a broadly diversified fund, what that means is it's investing all across the world, possibly in the U.S. as well, and that would have a little bit less risk than a very targeted fund. In a targeted international type fund, you're looking at specific markets, emerging markets, let's say, or a specific region or country, or small cap, and all three of those targeted type funds are definitely going to have a bit more risk associated with them. But again, as we've discussed, potentially faster growing, potentially more returns. So just to better understand why you may have more than one international choice. And if you only have one, chances are it's a broadly diversified fund. Now, I'd kind of like to bring it together by showing you how a mutual fund is, what it's made up of. So we have discussed three main asset classes. And when it comes to the investments offered in your particular retirement plan, they could include a combination of all those asset classes. A mutual fund is basically a professionally managed pool of money that invests in those various different asset classes we just discussed. They could invest in just bonds, just stocks, or a combination, which would create a balanced mutual fund. You see there that green box. So the scale that you see down below, the nice colorful chart, you start on the left with your low risk, low return potential investments, and that is your cash equivalents that we talked about first. So a mutual fund that's made up of cash type short-term investments, low risk, potentially low returns. And then in the middle of the spectrum, you've got your medium risk, medium return potentials, and that would be your bonds or debt securities, as we refer to them. That would include your balanced, which would be your target date type funds, funds that include both stocks and bonds in our portfolio perhaps. And even a spectrum, part of the international type funds can fall in the medium risk because the international funds can include bonds as well. And then you have your high risk, which is going to be stocks in general, so stock mutual fund, but there's a range there from your small caps to your mid caps to your large caps. But those all fall under the stock mutual fund category under higher risk. And of course, your international stock type funds would fall under that high risk category as well. So basically, again, hopefully you have a better understanding of where your retirement dollars are actually going. Yes, they are going into one or combination of those three main asset classes in the form of a mutual fund. So now let's take a closer look at the risk associated with these. And we're really going to focus here on two types of risk. In my meeting next month, I'll get into more detail about risk. But right now, let's take a look at our two types of risk. Number one, we have inflation risk. And number two, investment risk. So most often, I believe, when we talk about risk, we think of investment risk. And that is your daily volatility, fluctuations in the market. You take a chance every time you invest in a stock type fund that the market can go up and can go down. Your share value may be worth less one day than it is the other. That is investment risk. Okay, and most people, I think, are more clear on that. And when you think of risk, that's what most people are adverse to, is that uncertainty. And again, next month we'll talk more about how to help alleviate that by diversifying. The other type, the first one you see listed here, is inflation risk. And this is one I think people tend to overlook or forget about, especially during volatile times in the market, as we have seen recently, right? We become very risk adverse, and we think, well, if I could just protect what I have, which would be those cash equivalent asset classes, the risk you run there is that your money is not making enough for you to live on when you go to retire. You need to make sure that you don't outlive your money. So let's take a look at an example of inflation risk. Here we're looking at how even low inflation can damage your purchasing power. So we're looking at an annual income of $50,000 today in this slide, what it would look like in 25 years. The red line, that's if inflation were growing only at 2%. And it's 10, as of recently, we're averaging about 3%. But even only 10%, you can see where you are reducing your income of $50,000 now would only be worth about $30,000 in future dollars. And we all know that, 25 years from now, if we went to the grocery store with $100, we wouldn't be able to buy nearly as much as what we buy now. So then you see the blue line at 3% and then the green line at 4%, how significantly that reduces your purchasing power. So if you are not earning enough on your money to keep your spending or your purchasing power equal to what you had it before, that is your risk. And that is a big risk you would want to consider before allocating too large of a portion of your portfolio to a short-term, interest-tied investment like a cash equivalent. And again, in your plan, you probably have at least one fund, if not more, that's what's called a stable value or cash type equivalent. Then again, this is where the risk comes in investing too much or all of your money in that particular asset class. Okay, it does serve its purpose, and there's a reason it's in your plan, but your risk of not being able to outpace inflation is a real one. Okay, now let's look at it in a different way. Let's see here. My slides turn. Let's try this. Okay, now it's tough to show sometimes the investment risk. We know that there's the volatility and the ups and downs, but let's take a look at it in a different way here. The return potential for each of the asset classes. So yes, there is definitely risk of the market and outside factors, interest rates, things that affect this. But let's look at a period. This chart is showing us a period from 1961 through 2010, the potential growth of the three basic asset classes that we just discussed, and inflation in there as well. So $100 invested back in 1961. Let's take a look through 2010, through some very volatile market times, the potential growth. You see there, had you invested in stocks over the last 50 years, your $100 would be worth $10,459. Nice return. But if you can kind of see that mountain chart on the top, you do see some peaks and valleys. And when you're in the middle of one of those, it's not as clear, those return potentials. And trust me, I know, I was with all of you in 2008. So again, the risk there is that volatility. But long term, historically, we're looking at the last 50 years. And here we're just looking at the S&P 500 when we're referring to stocks, which is the 500 most widely held stocks in the U.S. So that's what we're looking at, investing in that index. Then if you look at the bonds, had you invested that same $100 in the bond market back in 1961, you would have $2,981. And you take a look at that red line, and it's a steadier climb. You don't see nearly the peaks and valleys that you do in the stock market, but the return is about a third of what it was had you been in the stocks. And then you have your short-term investment, which that green bar there, and again, even a flatter line with a total return of $1,308, $100 growth over 50 years. And then you have inflation. So this just kind of gives you another way to look at it, a more positive light, I believe, to the investment risk, not to belittle at all the potential, the strife during the short term, but again, very important that you see the potential. And again, we're looking at history here. Unfortunately, we do not have the crystal ball. I cannot show you moving forward, but this is the last 50 years. Okay, and then finally here, let's take a look at how and where your plan investments fall in this spectrum of risk and income versus equity. And since we are on a webinar including people from all different plans, we can't be too specific here. So this is a fairly generic slide here, and this is where I hope that our services at Pensionmark, we can assist you more on a personal, individual plan level and really show you where your particular investments fall in. But what we're looking here is an investment spectrum. Again, on the left is your least aggressive, lowest risk, and historically lower return investments. And then over to the right, you have your more aggressive. So once again, you start with your income funds, sometimes referred to as debt funds. And in there, you're going to have probably, again, your cash or stable value type option and all of your bond options. And then next on the scale, your plan most likely will have some kind of asset allocation funds, whether they're target date funds or just a blended type fund that it would include the different asset classes. And what that type of a fund does is it's going to seek to maximize your returns and minimize your risk. And again, next month when I discuss asset allocation and diversification in more detail, we'll get into that topic. And then you have your domestic equity funds moving to the right here. And again, in your plan, you probably have several choices in that category. And those are going to be stock-type mutual funds, and will be a variety of different market capitalizations. You'll probably have a large, a mid, and a small cap, and different styles as well. You'll have growth and value, or a blended type fund that would include both styles. And then finally, over to the right, most aggressive category are going to be your international equity funds. So this is your international stock funds. And if you potentially have any sector type funds, and this is where you have a mutual fund that's very specific and only invests in one part of the market or one industry, like a technology fund, or an international regional fund that's very specific in only one area of the world. Those, again, are going to be on the most aggressive side of the spectrum. So there you have your spectrum. And again, every one of your plans, whatever retirement plan you have offered currently at your employer, you have funds in every one of these categories. And the goal is for you to better understand what those funds are made up of, where your money is going, what the risk and return potential associated with each fund is. And with that, again, I'd like to just always remind you that at Pensionmark, we are available to help you. I would really encourage you to use us as a resource. We're there. Call our participant help center. We're there during normal business hours. We are there, again, just to discuss and educate and guide you in any way we can to help you feel more secure about your investment choices and that you're making the right ones for you. So with that said, I would love to take any questions that you might have at this time. Again, you can type those in on the chat. Let me see if I've got questions. Questions, please. We have some time, and I would love to do that. Let's see. I think I might be able to take everybody off mute. If anybody would like to ask a question. I so appreciate everybody's time this morning. Again, Pensionmark is here and pleased to serve you in your journey towards retirement security. If you have a question that I'm not able to answer today, or that we're not able to make that happen, please do call our client care department or email us at your convenience. I also hope if you're able that you're able to join me next month. Again, it's Tuesday, June 21st for our Asset Allocation Part 2 series. We are also recording this presentation. It will be available on our website if you'd like to pass it on to any of your coworkers, employees that you think might benefit from the presentation. We'd welcome that. Let's see. And one final thought as well, we have resources available to you. We have some wonderful newsletters that you can be a part of. We have a whole series of webinars that we would love to offer you if you would like some more detailed information on these topics. Well, once again, I thank you very much for your time. I hope you have a wonderful short holiday week here, and I will look forward to speaking with you in the near future. Thank you and goodbye.